Hello friends, in this video we want to talk about the price action. Every possible market, whether it's financial market or not, is being moved by the ongoing supply and demand that is present in this particular market. Supply or sellers represent the quantity of product that is available in the market, and demand or buyers represents the quantity of product that is wanted in the market. When there is more demand than supply, the price of any product is going to rise. Demand succeeds supply. And when there is more supply than demand, supply exceeds demand, the price of the product is going to drop. Selling at supply or buying at demand offers you the best price possible. So why would you want to pay more for a product, service, or currency if you can get it at a better and cheaper price? In trading, knowing where a supply or demand level is knowing and understanding what type of trader or trading account is on the other side of your trade. There are two different types of market participants. The novice trader that belongs to the 95% and the banks or institution and big money that belongs to the 5%. A small retail trader is not able to move price in the market. Only institutions and banks are able to do so. The good news is that it is possible to trade in the right direction and to follow the big money by simply buying at demand and selling at supply. In other words, it is up to you to choose which market participants you want to join. Finding a good supply or demand level on a price chart isn't that difficult. The first thing we want to do is 1. Look for an area on your charts where you see that price shot up for demand from a certain point in a strong fashion, or dropped for supply from a certain point in a strong fashion. We look for a specific point where price has to left, where it simply couldn't stay there. We can tell this because of the strong move up or down. 2. Once we found an area of the charts where the price shot up or dropped down in a strong fashion, we then want to see if we can find the base of the move. The base is basically a cluster of trading, where the candles' bodies are trading sideways next to each other, creating a zone. If you can find that kind of zone and then see price dropping or rising in a strong way from that zone, then you have a supply or demand area. On both of the examples, we clearly see the zones we were looking for preceding the strong moves. This is a demand level on the left and a supply level on the right. Once we found a zone like explained above, we want to define the base as well as possible by drawing a line on the upper and lower part of the trading cluster. There are two possible ways to define the base depending on the trader's preference. 1. Draw the upper line at the high of the cluster. Draw the lower line at the low of the cluster. 2. For supply, draw a line at the high of the cluster for the upper part and draw a line at the candle's bodies, open or close, for the lower part. For demand, draw a line at the low of the cluster for the lower part and draw a line at the candle's bodies, open or close, for the upper part. Another way to identify a zone is also to look at DBD, RBR, DBR, RBD. DBD means drop base drop. RBR means rally base rally. DBR means drop base rally. RBD means rally base drop. Let's look at some chart and find an example of it. Now that we know how to identify a supply or demand level, we should ask ourselves what the level represents. When the zone is being formed, we consider price to be balanced. There are as many sellers as buyers present in the market. However, a decision to push price lower or higher has to be made. So sooner or later, the balanced cluster that we saw will become imbalanced as there would be more sellers than buyers. This will cause a rise or a drop in price, and therefore price will break the cluster. The best possible scenario is price breaking the cluster in a strong, violent way, because if that happens, then we would know for sure that there were more buyers or sellers at this precise point. Therefore, we can expect price to bounce from there when the zone will be revisited. There are different ways to trade a supply or demand zone, but the highest probability trade is to trade the first visit of the zone, because since it's the first visit, the zone will still be fresh or untested. Furthermore, it's up to the trader to decide whether they want to take a touch trade, trading the touch of the zone, or wait for confirmation price action when price arrives at the zone. When a zone is getting tested for the first time, we know that this freshness gives us the highest probability trade. However, this doesn't mean that you have 100% guarantee that it will bounce there, as nothing is 100% in trading. Also, it is possible that price will bounce at the second or third visit. We don't know how many times it will be tested until the zone breaks. Every time a level is tested, it gets weaker and weaker. This is why the first visit gives the highest probability trade. Strengths of the move. Max 2. How did prices leave the level? Strong fashion, or a more gradual move away from the level, gives clues to supply and demand imbalance at the level. Strongest turn in price level is where supply and demand is most out of balance. So our quest is to look for price levels where supply and demand is most out of balance. The biggest clue is how imbalanced or out of balance prices are at a level. It's how quickly they leave. The more quickly they move, the more out of balance they are. How far did prices really up from demand level before coming back to it? That is initial profit margin. If buying at support or demand, where is the nearest area of supply? If risking $20 on trade, is nearest supply level $60 or farther away? If not, we are not interested in the trade. Support and demand levels all around, we only want to take the best. We may look at this different than conventional wisdom. Once prices have left the level, example of picture explanations, sell zone with a lot of candles, we want to enter on the first retracement. It is highest probability entry. First time entry is a 2. Second time is a 1. Third time is a 0. This is just motion into mass. The mass is the supply and demand, the biggest stack of orders. Chopping tree example. Every swing removes some of the mass. The more swings, the more chance to go through. Very much in line with first enhancer strengths. At price levels with supply and level out of balance the most, price will spend the least amount of time at the level. At price levels with the most imbalance, price will spend the least amount of time, few candles. If price is in balance, price will still there a long time. It is equilibrium. We don't want to trade there. We want to trade at the extremes. How many candles in what time frame? Be very careful about coming up with a specific number. Changing time frame will change the number of candles. At your time frame, compare the number of candles to time spent at other levels. Don't get hung up on specific number. How did price arrive come back to the level? We want to be anywhere near other levels. We don't want new resistance level before we buy, or new support levels to form right before we sell. Strong arrival usually means strong departure at the level. How to join the uptrend without taking a lot of risk. If there's an uptrend, buy a pullback to quality demand level. In an uptrend, buy dips. In a downtrend, because a market is basing and dropping, reverse is shorting rallies in a downtrend sideways markets. The rallies into supply, buy pullbacks into demand entries. Understanding where the turning points are is everything. Usually the real problem in trading is the entry. When you think you have a problem with targets or stops, the problem is usually a poor entry. 3 ways to enter into a position. 1. Limit entry. 2. Confirmation entry. 3. Breakout entry. Only 2 reasons for the market to have a turning point. At the top, supply level, the sellers exceed the buyers and prices move lower. At the supply level, at a number of buyers that were exceeding the number of sellers. The second thing that can happen is the buyers went away and the sellers exceeded the number of buyers and drove price lower. At the bottom, demand level, the buyer exceeding sellers and price move higher.